Functions of secondary markets. Secondary market offers benefit of liquidity of existing securities. An investor can buy perpetual securities at a low cost of transaction and sell it within a short span of time at low cost, or hold it for a later date and liquidate holdings later on. The forces of demand and supply enable price discovery of securities. Continuous flow of information ensures investors are able to make their individual assessment. If a security is attractive to investors, its demand exceeds supply, pushing up the price. On the other hand, if there are more sellers than buyers, prices get pushed down. Market price also works as a continuous monitor of company performance and investors' expectations. Information signaling. In efficient markets, prices reflect all available information about the company. As new information comes in, prices change accordingly. Secondary markets also generate indices, which are tracked as an indicator of economic activity. BSE Sensex and NSE Nifty are some of the popular indices in India. An increasing index is an index of healthy economic activity, while a sliding index suggests weak or weakening economic activity. Secondary market promotes a market for efficient governance practices. If the market does not have confidence in a company's management, it pushes down its share prices. These companies become takeover targets and facilitate change in ownership to a better management. The possibility of such takeovers itself ensures that these management drive to deliver good governance. Issuers list their securities on stock exchanges and comply with eligibility criteria, regulations, and rules of the stock exchange, while investors trade in these securities through intermediaries. Market participants. NSE and BSE are examples of two stock exchanges. Issuers have to meet the eligibility criteria like size, credit rating, etc., and pay the listing fees to list on a specific exchange. Investors trade through members, also called stockbrokers. Members, like issuers, have to meet minimum criteria of capital, qualifications, net worth, and others. The transactions in stock exchange pass through three distinct phases: trading, clearing, and settlement. Buying and selling of shares is also called trading. Major stock exchanges in India offer an electronic order matching system. Clearing is a process of identifying what is owed to the buyer and seller. Settlement is the actual mechanism of settling these obligations. Clearing corporations offer the clearing and settlement function. They act as a counterparty for all trades on exchanges. Depositories and DPs ensure securities are traded in demat form. National Securities Depository Limited and Central Depository Services Limited are the two depositories in India. Custodians are institutions that hold securities and funds for safekeeping for large institutions. Secondary markets are regulated by Securities Contracts Regulation Act 1956 and SCR Rules 1957. SEBI is the regulator. Indicators of market information. Market capitalization is an indicator of the market value of the share capital of a company. Based on this value, stocks are classified as large cap, mid cap, and the range of stocks with lower market capitalization are called small cap stocks. Market turnover reflects quantum of trading activity in a given day. A high turnover ratio reflects high liquidity. Indices are a representative indicator of the market value of a stock market. They can be broad-based or specific indices based on sectors like banking, IT sector, or based on market capitalization of stock, like an index for large caps or mid cap index. Market indices are a reflection of the economic activity. They also serve as a benchmark to compare performances of portfolio or mutual fund schemes. Indices also give information on real-time market movement to investors. Take a look at this screenshot of the price quote of Bharti Airtel scrip on NSE. Risk management systems. Risk management tools are adopted to mitigate risk of default by stock exchange members. To cover risk of default, a margin money requirement is set by stock exchanges. In this example, a 10% margin for a purchase of shares of 1 lakh rupees would imply that the investor needs to deposit 10,000 rupees with the clearing corporation. Capital adequacy norms. SEBI stipulates members to maintain a base minimum capital of rupees 10 lakh in normal conditions. Circuit breaker is a limit set for both indices and specific stocks. On a trading day, if the index or stock price breaches the circuit breaker, trading is halted accordingly. Based on the circuit breached, trading can be halted for 1 to 2 hours or suspended for the entire day. Penal charges are handed out for failure to pay funds, settlement obligations, or for margin or limit violations. Students interested in knowing more about these penalties can go through the link given in resources. Clearing houses have put in place a settlement guarantee fund to fund any residual risk in completing settlements. This is a pooled fund by the contributions of trading members. Inspection of books and price monitoring and action is another risk management system adopted by stock exchanges. Corporate action conducted by a company have a direct impact on the shareholders. Rights issue is an offer to existing shareholders to prevent dilution of holding. For example, a company may choose to issue rights at 1:2 at a price, but proportionate holding will not change. Investors can decline the rights offer or sell it, called renouncing the right. These right entitlements are traded as distinct from equity shares till the right issue ends. Go through the other formalities associated with a rights issue. Record date is the date set by a company to determine eligible shareholders for corporate actions like dividends, rights issue. If a record date for dividend is set as 3rd September, then shareholders whose name appears in the shareholder list on 3rd September will be eligible to receive the dividend. Dividends are paid out of profits. Dividends can be classified as final dividend or interim dividend. Loss-making companies cannot give dividends. Earlier, dividends were declared as a percentage of face value, but with different face values for different shares, it used to be confusing for investors. To avoid the confusion, dividends are declared on a per share basis. Bonus issue is made to existing shareholders without consideration. The face value remains unchanged and it increases equity capital. For example, a bonus issue of 1:4 will entitle shareholders with 1 bonus share for every 4 shares, and shareholders will have 5 shares by the end of the issue. Stock split gets confused with bonus issue, and it is important to highlight the differences. You should go through all differences mentioned on the slide. Stock split is a split of existing shares. Another key difference is that issue is not made out of reserves. A 1:4 split of shares will split 1 share into 4 shares and reduce face value accordingly. If the face value before issue was 100 rupees, it will go down to rupees 25 after the split. Shares buyback. Buyback issue is done to increase EPS and support higher price. The buyback has to be concluded within 6 months of opening of the offer. Go through all details about a buyback offer mentioned on this slide. Other corporate actions include delisting of shares and merger and acquisitions. In merger and acquisitions, the acquiring company has to make an open offer to existing shareholders. If more than 5% shares have been acquired in a financial year and the acquirer holds more than 25% share in the company, the minimum offer needs to be for 10%. If acquiring company holds less than 25% equity, it has to make an open offer for at least 26% of the share capital.